Good afternoon. My name is Michelle Hale, Community Outreach Supervisor for Greater Nevada Credit Union. Joining me today are my teammates, Saray and Chris. Thank you for joining us on this recorded presentation. We would like you to put yourselves on mute until the question and answer sections. Greater Nevada is finding a growing need for financial education from our community members. Each month, we will be showcasing a financial topic that we hope will help our community move forward with financial wellness. If you're interested in learning more about these webinars, please check out our website at gncu.org and search for Greater Financial Wellness Hub. Today's presentation is on refinancing your home. I would like to introduce your presenter, Danielle Kirby. Danielle moved to Northern Nevada in 1994 and became a regional sales manager with a large company. In 2000, Danielle obtained her real estate license and quickly became a top producer. With this background, Danielle understands the intricacies and the importance of real estate purchasing process. She is committed to providing her clients with world-class service and making their purchase or refinance an easy and stress-free process. Danielle enjoys an active lifestyle and has competed in many marathons and triathlons, including the Lake Tahoe Ironman event. She loves to be in the outdoors, travel, and spend time with her husband and 2 sons. Welcome, Danielle.
Thanks so much for having me. I'm excited to be presenting this class again. So today we're talking about refinancing your home. And why does refinancing your home make sense in today's climate? Well, there's a lot of factors to consider. We've just now, experienced our first pandemic, and what did that do to us financially? Are there things we can do to take control of our financial well-being? And one of those things can be advantageous. One of those things can be refinancing your home. So let's talk about why refinancing your home might be a good idea in moving forward with financial stability and financial wellness. Number one, debt consolidation. So, I spoke with a woman just yesterday that when the initial pandemic hit, she went out and stocked up her house with anything she might need for the next 12 to 18 months, and now has almost $35,000 in credit card debt. So if we're looking at credit card debt at 22%, does it make sense to maybe pay that off by taking some money out of our house and consolidating that debt? And we'll get into this later, but that's one reason. Another reason is I've got, interest rates are incredibly low. Does it make sense to move from a 30-year loan to a 20-year loan so I can pay off my home faster and my interest rate is less? That's another great reason. Taking out cash, which is kind of what I touched upon earlier in consolidating debt. You can consolidate debt, pay off those high interest credit cards, or even take out cash to potentially remodel your house. How long have you been in your home? Do you need to spruce it up or want to spruce it up a little? Those are some factors to consider. The other thing is did you recently buy your home? Did you buy it within the last couple of years and it was your first home? Do you pay mortgage insurance? Do you, is it possible that 2 years ago, interest rates were at 5% and now they're possibly at 3%? What does that look like in reducing your overall monthly expenses to increase your financial well-being? Another reason could be that you originally started in an adjustable rate mortgage where that rate is on a sliding scale, and now you can qualify for a fixed rate loan. So there's a lot of different reasons it makes absolute financial sense to refinance a home. These are just some of them. There are some pros and cons. So when you go to refinance your home, it's no different than getting pre-qualified to purchase a home. We do have to pull your credit. there is a credit score impact, because anytime you ask someone for credit, there's going to be a hard inquiry on your credit report. Typically, it doesn't do too much to credit. It can range anywhere between 3 and 10 points going down. But once you start paying that mortgage on a timely basis, it goes right back up, okay? Closing costs and fees. So I often get people in here saying, oh, so-and-so has a program that's absolutely no cost, no fees. Really, you need to do some more investigation on those advertisements, because refinancing a home is no different than getting your first mortgage. In other words, there are fees and costs associated with making sure your original mortgage, or the mortgage you currently have, is paid off, and that payoff is recorded. There's costs associated with putting your new mortgage in place. There's title insurance. There's various things. And what I do is I do my best to roll that into your new loan. In other words, if you owe $200,000 and the cost to refinance is $3,000, your new loan amount would be $203,000. So you're not coming out of pocket, but it does cost you. If you're saving money overall, does it make sense to do that? So those are things that we look at as consultants and say, yes, it makes sense, because you're going to be breaking even potentially in 2 to 3 years on the cost of this refinance. So moving forward, all you're going to be doing is saving money. So again, lowering your interest rate is always a great idea. The rule of thumb I give my customers is, as long as you're reducing your interest rate by about 1%, it makes sense to refinance. That can be a little different if you're getting rid of mortgage insurance, but again, good rule of thumb is 1%. Refinancing to shorten your loan term. Let's say you bought your home 10 years ago, you want to refinance, but you want to move into a 15-year loan. So you have it paid off by the time maybe your kids go to college or you retire. Those are other factors to consider. Debt consolidation is really one of those things that I get on my soapbox about. So if I start talking too much, Michelle, just cut me off. But debt consolidation, especially through the pandemic, we saw people laid off, and debt may have increased. Have you gotten to a point where your credit cards are maxed out, you're paying 22% interest, and you're having a hard time making those minimum payments? Rolling that debt into a refinance and lowering your monthly outgo to the tune of $500, $800, depending on how much debt service you're carrying, doesn't make sense to do that to put you in a better financial position moving forward. So that's a huge consideration. The other thing is taking out equity. I know for myself, I've looked at selling my current home that my family and I are in and moving to a different home. And quite frankly, our real estate market has gone crazy. And, I'm sure people out there, if you're taking this class, you're watching the value of your home go up and you're like, I can't believe my house is worth this much. So maybe instead of selling and moving to a new house, maybe taking out equity to pay for that kitchen remodel, potentially college tuition. It is making your money work for you. In other words, if I can get funds from my home and I keep throwing out 3% because it's an easy round number, but yet my investments are making 10%, why wouldn't I pull money out of my home, pay on that 3% when other funds are making more money for me? So it's about setting up your financial stability moving forward. And does it make sense today in the moment to reduce your monthly outgo so you can get ahead, faster? So with that, are there any questions so far?
Hi, Danielle, and thank you guys for joining today. My name is Saray Helms. I'm the Community Relations Specialist here. Hopefully you saw, but I'll be helping in the chat today, and we'll be taking a few of these question breaks. So we welcome you if you want to take yourselves off of mute. We would love to meet you. If you're interested, you can type them in the chat, and during these questions breaks, I'll speak up for us and ask Danielle, but nothing as of yet. Well, actually, we just had one come through. What are mortgage points? I've heard about these points. Can you speak a little to that?
Absolutely. So, we publish our rates. We get rates from, that are published that we can offer. We purchase rates. And so we offer these rates to our members, our community, and a rate, and again, I keep going back to 3, a rate could be, dependent on your credit score, your debt to income. And again, I'll get into that later, but points can be, I want to get to a 2.5% interest rate. How can I get that interest rate? Well, based on current pricing, how many points is that? What does it cost me to buy down to that rate? And does it make sense? So that's what points are. Points are, some banks will say, yeah, there's no cost to refinance, but if you want this interest rate, you're going to pay 4 points. Well, that's pretty expensive money. So again, it's weighing out your options and looking at, well, okay, there's a cost. Does it make more sense to buy down my rate, or does it make more sense just to get published rates at 0 cost to do my refinance? And again, it's all very situation specific to each individual person as to what makes sense. So again, those are sort of on a case by case, but that's what a point is. It's just the cost of buying down your rate.
Thank you. Yeah, that definitely helps. And I did have one come through email, and you can also type them through email if you guys would like that privacy. It's GNCU. Let's see. Let me type it in the chat for you. I think I might have put it. GNCU Financial Acceleration at gncu.net. It's a long one, so I'll type that in so you can copy and paste. But one came through and I think this applies to one of your first slides. When we run the credit, even though it is like buying a new home and refinancing, is that going to be a soft inquiry or a hard inquiry for us?
A hard inquiry, because we're going out and we are applying for credit. We are applying for credit. Soft inquiry is when someone's offering you credit. Hard inquiry is when you go out and apply for it. And mortgage always runs all 3 bureaus, TransUnion, Equifax, and Experian.
Perfect. Thank you so much. And I think that's it for now, so we can continue. Thanks, Danielle.
Absolutely. Okay, so let's talk a little bit about cash out versus rate and term refinancing. And this is, so before I get into examples, in terms of rates, the best rate you can get is when you're actually purchasing a home. That's sort of your best offering of rates. Then the next sort of tier of rates is a rate term refinance, meaning I'm not taking any money out. I just want to lower my interest rate, lower my payment, or change my term, shorten the length of my loan. And then if you do a cash out refinance, there's a little bit of a higher interest rate for that because there's more risk to the lender. So let's talk about these examples. Example number 1, John wants to refinance and take out cash to pay for upgrades to his outdated kitchen. The cost for this is $50,000, and John has $200,000 of equity wrapped up in his home. Equity meaning his home is worth $400,000. He only owes $200,000 on that, so he's got $200,000 of equity sitting there. John is able to pull some of that equity out to pay for his kitchen remodel. Okay, again, cash out refinance. Example number 2, Kathy has 5 credit cards with high balances, and she's paying 20% interest on those. She has enough equity in her home where she could utilize some of that equity to pay off her credit cards. This is also considered a cash out refinance. And again, you're going to take about 1/8 of a point to maybe 1/4 point, a little bit higher interest rate. Now, when I'm talking about that, that's not a lot, you guys. So if we're talking about a rate term refinance versus taking cash out, your rate could be a difference of 3% to 3.25%. So does it make sense to pay 3% interest instead of 20% interest on those credit cards? It absolutely does. So those are your examples of cash out refinances. Rate term refinances, again, just lowering my interest rate or changing the term of my loan, meaning going from a 15-year to a 30-year. And there's a lot of different reasons we'd want to change our terms. So Susan currently has an interest rate of 4.5% and found out that rates are much lower. She can get a lower interest rate by refinancing, which substantially lowers her monthly housing expenses. So simply by lowering your rate, I mean, I have saved people anywhere from $250 a month all the way up to $800 a month. So it really can be beneficial to your immediate financial needs and moving forward to refinance your home. Example number 4, Crystal purchased her first home 2 years ago with an FHA loan. She pays monthly mortgage insurance. The price of her home has increased substantially to where she can refinance and eliminate mortgage insurance from her payment. One of the things that I want to kind of bring to everyone's attention here is that I specifically use the example of an FHA loan. FHA loans are awesome. They really help first-time home buyers get into a home. If anyone is in an FHA loan right now and they have seen their equity go up substantially, it makes sense to refinance, and here's why. With an FHA loan, mortgage insurance never goes away. It is there for the life of the loan. If you refinance into a conventional loan, meaning not a government insured loan, when you have over 80% equity, that mortgage insurance is required by law to be removed. But an FHA loan has it for the duration of the loan. So again, another really good reason to refinance out of that FHA loan. So not bad against FHA, but just something that I wanted to point out. Great programs to help get that first-time borrower into a home. But again, does it make sense to refinance out of that to get rid of that mortgage insurance? Any questions? Any more questions so far?
Hi, Danielle. It looks like we have one and one is typing.
Okay.
I really like this question. How do we even know if we have equity in our home?
Okay, so that's a great question. So what I do is I cheat a little. You know, if you look at your mortgage statement, on your mortgage statement, it'll say, you know, it'll give you what your principal balance is. If you go to, you can go to realtor.com, you can go to Redfin, you can go to Zillow. I typically cheat when I'm talking to a customer and I go to Zillow and, you know, there's a tab right there. How much is my home worth? You put in your address and it typically will pop up a figure. Let's say Zillow says that figure is $350,000. Your mortgage statement balance says you owe $250,000. You have $100,000 of equity in that home, approximately. So that is an easy way to find that out.
Thank you. I love that, and I'm a big fan of all of those. I look at Zillow all the time. I really liked this next question as well. So
Also,
you said that there's a difference in percentage rate for cash out. Can you explain that? And to kind of add on to that, how is a rate determined for me as a borrower?
Okay, so how a rate is determined for someone as a borrower, we're going to get into. So I'm going to save that question because it's in the next upcoming slides.
Perfect.
But rates are determined. So, and again, we're going to kind of delve into this a little bit deeper, but a cash out refinance rate is going to be higher. Why? Because I'm now tapping into the value of my home. I owe $200,000. My home's worth $400,000. I'm going to take out $300,000. I'm going to refinance and take out $100,000. So my new loan amount is $300,000. So based on your loan to value, equity versus how much you owe, worth versus what you owe, my loan to value, so that's going to be, your rate can be dependent on that and your credit score. And again, we're going to get into this, but it's more risk to the lender the more you owe on your home. And so that's why your interest rate's going to be a little bit higher on a cash out. And again, we're going to get into all the factors that go into that. So if there's more on that question later, I will be happy to answer it. Soraya, more questions, or should we just jump right into?
Yeah, I think that's a great, and I love that you related to, I just think almost like a personal loan. Okay, gosh, it's a lot better than to have that in your home than a 9%, 10%, 11% plus personal loan. No, I think that's great. And if that's going to answer on the next slide, we can go ahead and continue.
Awesome. Okay. So this is what a lender is looking for, and this is exactly what I wanted to get to in determining rates. So oftentimes we as consumers get fixed on rates because why? We are trained to do so. All of the advertising, all of the media, if you're watching a baseball game, for example, what's one of the major commercials that you watch? Quicken. Get pre-approved on my phone. So what is it that we really need to look for? So interest rates are not actually just a published rate. Interest rates are dependent on 4 factors. So number 1, your credit score. Your FICO credit score is very important in determining rates. The higher your FICO score, the less risky of a borrower the thought is, the less risky of a borrower that you are. So higher credit score gets a better interest rate, right? The next one, I'm going to go with loan to value. So if I have a home that's worth $500,000 and I only owe $100,000 on it, I have a very low loan to value. If I take out a little bit of money from that home, let's say to the tune of $200,000, I still am at a 40% loan to value. I have 60% equity and a 40% loan. Does that make the lender want to give you money? Yes, because it's a safer loan to make. There's less risk involved. The lower loan to value gets you a better interest rate. Debt to income. That means we take your income, gross income. I make $5,000 a month after taxes. It's, $3,500, let's say. So we're going to take your actual gross income for the month, $5,000. We're going to subtract, say, car payments, credit card payments, any debt service that you have, revolving or installment. We do not take into account cell phone bills, electric bills, grocery bills. So your debt to income for qualification reasons needs to be 45% or below. And if it's lower, again, less expenses, the better interest rate you're going to get. So again, what I really am trying to stress is that rates are not dependent on the market. They are a little, but they're also very dependent on each individual person's situation. So you're going to get better interest rates if you have shown to be a responsible borrower. Last but not least, there are reserves. Do you have contributing factors to why a lender would want to lend to you? You know, I have Greater Nevada is really awesome in that way. We can say, all right, this doesn't meet typical guidelines, but there are enough contributing factors. You know, this person has a 401k with, you know, $100,000 in it. Is that a contributing factor so that we can lend to them? Yes, it is. So again, these are the big four. This is what we look for in lending. And again, it's no different than purchasing in terms of interest rates and getting your refinance completed, because again, even though you've already purchased your home, refinancing, you're still going to have a ton of paperwork because you are essentially applying for a whole new loan. So we need to get all of that paperwork that you did when you purchased your home back again in order to refinance. You're taking on a whole new mortgage. So again, just because you're refinancing, there's no difference in the paperwork load to the lender to get that new loan. So I'm hoping this answered the questions in regards to interest rate. But if not, we can answer more of those in a minute here. So again, the one question consumers ask is, what are your interest rates? And again, like I said, no interest rate is the same for every borrower. Those four factors go into determining interest rates. So what I turn around and tell my customers is, it's not about what our interest rate is. Let's find out what your interest rate is. And based on your interest rate, what makes sense in refinancing your home? Let's break it all down, costs, and at this point, does it make sense to maybe buy down, pay some points to buy down your interest rate? So, and again, most talked about and misunderstood part of the home loan process is what affects rates. And I go back to those big four: loan to value, FICO score, debt to income ratio, and any contributing factors. Rates are advertised. So Greater Nevada, I really love how we advertise our interest rates right on our website. There's not a lot of people who do that. I feel like there are some companies out there that dangle a carrot and say, oh, so a lot of people are getting junk mail that say, oh, we can reduce your interest rate. Did you know that you could save up to $400 a month or $800 a month, or you could reduce your interest rate in half? These are carrots to get you in, because I think people, once they get you in the door, think that they can sell you their product, which having knowledge by attending classes like this is huge. So interest rates are advertised in a various array of ways. Again, often those are advertised rates to get you in the door. And then once they take a look at your credit application, it's like, oh, then the tables turn and the advertised rate is not actually your interest rate. And that's why I kind of harp on that. Interest rates are different for every borrower's situation and every borrower's credit file. Now, locking in a rate means, so I get a new rate sheet every hour. So rates change basically every hour. Rates are tied to the bond market. Typically the 10-year treasury bond is what we watch to find out if rates are going to stay where they kind of are, or if they're going to take a major change. So one of the things that we can do when you go to refinance your home is take a look at what rates look like today. Do we want to watch them? Is there something that's going to go on in the bond market that makes us feel a little uneasy? So I say all this because locking in a rate, what does that mean? It means that I'm going to move forward with my refinance. I think it's going to take about 30 days to do so. I like the rates where they are right now. It works for me and making a smart financial decision. I'm going to lock that rate in. That means I am guaranteed come the close of escrow, I have that rate and it's not going to change. That means should interest rates go up, you are locked in at the rate that you locked at. Let's say it's 2.5%. Should rates take a nosedive, in other words, go down to 2%, you are still locked in at that 2.5% interest rate. Again, we as consultants sort of watch those things. My best advice is to lock in as we're discussing, unless we see something that's going to make a huge determining factor in lowering rates. Rates are at such an all-time low right now. My recommendation is to always lock, only because I don't see them going anywhere else but up. But hey, that's just my own opinion. And again, how is my interest rate determined as a borrower? We talked about this, the big four: debt to income, loan to value, FICO, and assets. And one of the things that I like to bring up in talking about a FICO score is a lot of people monitor their credit on Credit Karma. Credit Karma, so in talking about credit scores or FICO scores, we use the big three: TransUnion, Equifax, and Experian, and they are all based on the Fair-Isaac scoring model. Okay, and that algorithm is so complicated. I mean, I don't even begin to understand it, but that's what the Fair-Isaac scoring model is. When you use Credit Karma, so there's 69 different scoring models out there. When you use Credit Karma, it's a personal scoring model that is not recognized. So when people come in and, or when people are like, well, wait a minute, why is my credit score, you know, that you pull so different from my Credit Karma? It's because Credit Karma is a personal scoring model that is not really recognized anywhere. So keep that in the back of your mind, especially if you're watching your credit or wanting to improve your credit. Okay, so we talked about what is your rate, and that is, again, dependent in and on your specific personal situation. I'm hoping that that answered the question from previous, but if there are any more questions.
Yes, actually, I think it answered a few. You weren't lying. These last two slides, we had questions coming in, and you answered almost all of them, but I want to make sure. One of the questions was, hey, my credit card company offers a credit score on my login, but is it a true representation? And I would say that's just like Credit Karma. It may be only pulling a little bit of that information or not from the credit bureaus, but I can absolutely put a resource for a link where you can get your credit reports, all three of them, for free. And it's annualcreditreport.com. I'll post that in the chat right now.
Absolutely, that's a great resource.
Yeah.
I recommend so one of the things about that is you can pull all three bureaus at once, or you can pull one bureau quarterly, which is also a good thing to do just to kind of monitor what's on there. It's so, you know, you get one free credit report per credit reporting agency per year. So again, just good to know what's on there.
Thank you. And then the next one, I love this because I could learn from this question as well. So thank you for asking it. What's the best time frame to wait from when you purchase your home to when you want to refinance? This person's had their home increase in value in the last 2 years, and they want to do some home improvements.
Absolutely. 2 years is a great rule of thumb. One, because so again, I don't want to keep saying it's dependent on your individual situation, but it is, because there's a lot of factors. Did you get a grant when you purchased your home? Was that grant forgivable, or do you have to pay it back, and how much do you have to pay back? Typically 2 years to get rid of that mortgage insurance, to get to see value to where you can actually borrow against it, to take cash out. That's a great sort of general time frame is to wait 2 years. I've done some people in 18 months. Again, it's dependent on, where did you buy your home? What has it increased in value to now? And what is your goal? How much do you want to pull out? Do you just want to do a rate term? Do we have mortgage insurance? But 2 years is a great sort of guide, if you will.
Perfect. Thank you so much. Yeah, 2 years. It looks like that person could be ready for some home improvements, which that's exciting. I think this is a great one. This is referring to the big four. What's an ideal DTI or debt to income ratio or percentage when trying to get approved?
Okay, so ideal in a perfect world is 30% or under, right? But in order to get approved, maximum, I tell people 45%. So if you're looking at a DTI, excellent borrowers, little to no credit, your DTI is 30% or lower, that's awesome. Same with a credit score. So one of the things that people don't know is, I'll ask people, hey, about what do you think your credit score is? People are like, oh, it's 800. Anything over 760 is considered excellent. So you could have a 761 versus someone who has an 810, it's treated the same. Debt to income ratio, 30% down to 15%, considered excellent. Anything, you have to be under typically 45% in most situations to get approved.
Perfect. Thank you so much. And I know, right, we always try to say 30% is what I teach in our youth education classes for sure. And I love this one. I think it's another broad one, and I can absolutely jump in where you'd like me to. But I think this one, just as you say, it depends on everybody's personal situation. And I think everybody wants an answer to this one. What's the best way to increase our credit score fast?
Love this question. Okay, so there's a couple ways. So credit, it is a crazy thing, but there are a few little hacks that I've learned through the years. Number one, let's say I've got a credit card with a $1,000 limit. The best way to increase that score is to not let that limit go past 30%. Don't ever let that balance go past 30% of your available credit. So if I've got a $1,000 limit, I want to make sure that I never let it go over 300. The other thing is that, let's say when you were 18, you went out and got a Best Buy card and you still have it, but you don't use it. Go buy a pack of gum on it and pay it off, because that is your oldest trade line. That has history. And if you have had that card and you kind of use it only when you want to buy, it used to be CDs. Now it's, whatever the case, TVs, cameras. Anyway, whatever it is, if you have the oldest trade line possible and you're not really using it, tickle that trade line a little bit. That will help your credit score go up. Because it's history. So we want to keep our revolving debt low, under 30%. We want to keep our oldest trade lines sort of open, because that creates history, and that's good too. Trying to pay off your balances as they come in is really good. Often people think that, oh, if I pay off my credit card balances and I don't use them, that's good. No, it's not. You want to show that you can handle credit responsibly. So again, you want to keep tickling those trade lines to where you get your gas on one, but you pay it off. So there's that. The other thing that I really love, and I've used in several situations, let's say mom or dad, grandma or grandpa, brother or sister, close friend. Let's say they have an amazing credit score and you want to help get your credit score up. If they put you on as an authorized user, all that does is, what you're doing is you're borrowing their good credit and it's reflecting on you. Have them put you on as an authorized user on their oldest trade line that they pay off every month, And that will almost within 30 to 45 days increase your credit score. So anyways, those are my 3 sort of rabbit out of the hat trick.
I love it. And I just want to say, we record these presentations, and we did one a couple months back, and I was so glad I got to attend, but it was on credit building and rebuilding. And that should be up on our website really shortly. So keep looking back for that. It's on our financial wellness hub, and I'll go ahead and plug that in. And then I'm also putting some resources in there. We have a free financial kind of fitness program called Balance, and they do offer some credit counseling and just an overview, and I'll put that in there. The other question was, what was the best person to reach out to? I've seen my credit raise over 140 points in the last month, which is incredible.
Amazing.
We don't see that very often, so you should be patting yourself on the back. And I know we're always trying to get a little bit higher. And I would say go ahead and see the Balance. You can always visit any of our branches. And then definitely watch that credit building and rebuilding once we get it up on that website. So keep an eye out for it.
Yeah, the fact that someone could raise their credit score 140 points, that's amazing. Great job to you. I actually want to know what you did to do that, because that is awesome. All right, let's move on here. Okay, so Soraya just talked about some of the resources that we have. You can go onto our website here. You can see, you know, GNCU and EverFi. This is the benefits and costs of buying and owning a home. Again, most people on this refinancing video or tutorial most likely already own a home, but I'm happy to talk to people if they want to know what the benefits are. And right now with our housing market, it is definitely a good time to own a home. These are additional resources that you can find on our Greater Nevada website. We have mortgage calculators. So if you're interested and you're like, okay, I see here on my mortgage statement that I owe $150,000, but I'm at 6% interest. If I were to get 3% interest, what would that look like? And you could go on and plug those numbers in to this mortgage calculator. I'm sort of a numbers nerd, and I love mortgage calculators. They're just really a lot of fun. Mr. Ray just mentioned the Balance Financial Fitness that we have as a financial tool. And again, the EverFi resource for home ownership. Let's see here. And I mean, that's what I have for you guys for today. Any other questions?
We did have one come in.
Okay.
And I can't believe we haven't hit the subject yet.
Okay.
It was, can you tell me about HELOCs, especially on the subject of refinancing, maybe wanting to do some remodeling? Thank you for asking this question. I can't believe we didn't get to this.
Well, so HELOCs are a great tool. One of the things that I like about a HELOC, our HELOC at Greater Nevada, is zero cost up front. So our HELOC, and what is a HELOC? I compare it to a credit card, but it's not. I don't like using that term, but it's the best sort of simplest language I can break down for people. It is a revolving amount that is tied like a second loan onto my home. So I actually have one, and it is an amazing tool. What it is let's say, okay, I have equity and I don't want to really refinance because I'm at a great interest rate right now, but I do want to remodel. So you can tap into that equity with a home equity line of credit. You can, the minimum amount to borrow with Greater Nevada is $25,000. Again, your debt to income ratio has to be under 40%, and you can borrow up to 80% of the value of your home. So I'm working on one for someone right now. She wants to take out $50,000. She wants to pay off a medical collection and then potentially redo her kitchen. The great thing about it is when you use your HELOC, you're only paying interest on the money you borrow. So in other words, let's say I start out with $50,000 attached to my home. If it's just sitting there and I never use it, I never pay interest on that HELOC because I'm not borrowing against it. Let's say that I borrow $10,000. The nice thing about our HELOC is the only required payment is the minimum payment, which is interest only. So this can get a little tricky. You have to, I want to teach good financial balance. I don't ever recommend just paying interest only, but it can work out for, it can work out well in certain situations. The other thing that's nice about a HELOC is, let's say, you're getting bonused, from work, but you need to go, purchase a new water heater and that bonus hasn't come through yet. You can, borrow the $3,000 to replace your water heater. When the bonus comes in, pay it off. And now you've just used a very low cost way to get to an end result. So again, a HELOC is open. You can borrow against it, pay it back, borrow against it, pay it back. And the one thing I will say is that it is an adjustable rate. So it is not fixed and it is tied to the Wall Street Journal's prime rate. So whatever Wall Street Journal publishes as their prime rate, that's what we charge in interest. So the risk with the HELOC, which a lot of people want to do to cash out versus the HELOC, is what if prime goes up to 17%? Your HELOC's going to go up to 17%. So bear that in mind when doing HELOCs, but I think they're a great tool, especially in emergency situations. You can just have it sitting there and do nothing with it in the event of an emergency, and your water heater explodes all over your house or whatever the case may be. It's a nice sort of safety net to have.
Well, thank you.
Questions?
We'll give a few minutes. I think there might be a couple questions, but I'm not sure.
Absolutely.
We may have some typing. We'll leave it open because we do have a few moments, and I'll absolutely put Danielle's information in. Or if you have any questions, please let us know. You can always email us at that gncufinancialeducation@gncu.net, and I'll put those in there too. Michelle, I'll pass it off to you.
Well, thank you guys. Thank you, Danielle and my team, and to those who are attending Greater Nevada Financial Wellness Series. For those that would like more information from Danielle, we will be sending out a follow-up email with the survey and Danielle's contact information. If you're interested in learning more about our webinars, please check out our website at gncu.org and search for Greater Financial Wellness Hub. And we want to again thank you all for being here.
Thanks for having me.
Always a great pleasure, Danielle.